Welcome on board then Samir Arora from Helios Capital. Find out what he's anticipating from the budget, what the market mood is, what are his thoughts. Samir, hi, morning. Good to have you on ET Now as always. Firstly, I want to begin off with what do you think is going to be the biggest focus area of the Modi government in this budget?
So I think the Modi government will continue to focus on the priorities and objectives they had over the last 5-10 years, primarily to do with fiscal control, fiscal discipline a little bit, and whatever fiscal deficit is there to target it towards infrastructure development, mostly in the same areas of road, rail, and maybe defense. But of course, they will have to also take into account this time the fact that they lost many seats in the election, much more than they would have imagined or expected. And so there'll be some feedback they'll take from those results. But still, I think big focus would be on more of the same, since the ministers are the same, since the policies, at least as expressed in recent interviews by everybody, are continuation of the past.
Hi Samir, Anisha this side, but I understand you're saying it's going to be more of the same, but there could be a more populist tilt, you believe, given the kind of verdict that they got, which was broken in nature?
So my thinking is that the populism, if any, will come in the state budgets, because that they can handle one state at a time. If they do populism at the center, it gets diluted because it also goes to states which are not going for elections. It also goes into states where the Congress might be leading or there, and there is not enough room also to do everything together. But also, if you do too much populism, then the opposition can claim that it is because of their policies that the government is forced to react. So the best thing for the government would be to say, no, those policies themselves are wrong, but on the margin, we have got some feedback on what needs to be done, and that can be dealt best at the state level. But also, there is some room for a little bit of populism because of the big dividend that the government got from Reserve Bank of India. So you can give, maybe 10 billion here or there dollars, which would be something like 0.2, 0.3%, a 0.3% type of deficit for even those things because of the big dividend that has been received this year. Then next year we can worry again. But this year, I think overall budget will be good because it will meet the market expectations. Now, whether it is good enough to sustain the high expectations, I don't know, but it would be a good budget, I think.
Samir, you mentioned market expectation. What is your wish list from this budget then?
So my thinking is that, first of all, the market should not be disappointed with any direct to market taxes, which is primarily true with capital gains tax. Now, there's a government, not policy, but government indications from SEBI, from Ministry of Finance, from Reserve Bank, that they are uncomfortable with the extent of speculation or derivatives and futures and options, and that they will discourage. Now, whether that is part of the budget or it happens in subsequent days, I'm not sure. Maybe it happens afterwards. The other thing from expectation point of view, where I think it'll be a bit of disappointment, is in some of these investment areas where the expectations have gone way ahead of what any normal government can deliver over any 4-5 year period, which is to think that every day there'll be a power project and new freight carriers and new investments to that scale. And therefore, as I said, the budget will be good in the sense that it will be continuation of the same. But in some of these investment related areas, the market seems to have gone even ahead of what a good budget can satisfy.
Okay, let's see what this budget does satisfy. But despite the various government measures that we have seen on consumption, the rural pickup has been slower than anticipated. What more do you think the government can do with respect to pushing the rural consumption, perhaps?
So the thing is, in one sense, let us say that the government gives 10 billion, some big picture number, let's take, and gives it to the deserving and the poor and the rural. But the basket of the consumer itself has changed. So, for example, just the telecom price hike alone is worth how much? Reached $3-4 billion. So you basically neutralized at least 4 billion out of, say, a 10 billion expansion that is given to the budget or to the deficit to help the rural, because the basket itself has changed, and therefore it is very difficult for the stock market to be able to assess that what should be done and which company will benefit. Because I don't think that the even the rural India or the lower middle class or lower class, the basket is the same, that they will go and buy soaps and shampoos if you give them more money. They might use it to get data, or they might use it to buy a better phone, or they might use it to buy things which look good on in photographs and on social media or on WhatsApp groups. So everything has changed. But what they can do in the budget, I don't think they can do much directly, which would be visible in a few months. Therefore, the best strategy for them is to tinker a little bit later on, not in the budget, with the GST, to make some visible things have lower tax, maybe even cement one day or something which they can say will feed into the whole economy, and separately continue otherwise with the discipline that they have shown so far.
Okay, fiscal discipline is something which is important. They can maybe tinker around GST and cement, etc., a few things later. But do you anticipate any tinkering on the personal taxation front or not at all?
I think there will be a some expansion of the minimum this thing at which taxes are charged. But I think in the end it doesn't matter so much, because if you say that the tax, whatever, the first bracket is not at 5 lakhs but at say 7 lakhs or something, then you are really giving the 10% to a few people who are exactly in that bracket, and most of that amount in absolute would have been more or less taken away by even just telecom, I think, and inflation in general. So it will matter on the sentiment, but it won't change people's lives so easily. I think people's lives, if they want to change materially, then you have to do a little bit of a compromise between infra and giving. We can't call it subsidy, but giving some tax set-offs, so or a tax rate cuts. I think that is not happening, so it will be more cosmetic.
Okay, a bit of a cosmetic change perhaps, but Capex has been one of the big focus areas and they have been doing a lot. It's close to 13 lakh crore, the kind of budget that we have right now. Do you see a possibility of a big boost there? And if yes, which verticals do you think will get the maximum share of that increased Capex spend?
So I think that if you look at what the PSUs are announcing, so all these, even oil and gas PSUs and the power PSUs, everybody's announcing big investments. So it looks that the government is moving the responsibility of big PSUs, sorry, of big infrastructure type investments or capex to the PSUs, because they are realizing that they will have less and less scope, because over time your tax collections cannot be much higher than the underlying GDP growth. Currently, it is higher because you are saying that more compliance is there, and therefore more people are giving who are not giving before. That's why even if the GDP grows, say, at 11% in rupee terms, in theory, you're supposed to get tax collections in the 12-13% range, but you're getting much higher because of better compliance. And that can't be a lifelong strategy, that you will get more and more from compliance. So I think there might be a little bit more on investments, but there are now more claimants for that money. So if they can keep it in line also, it's okay. I think whatever they do, 99% it will disappoint the expectations of the capex driven companies.
Okay, so that's a take on the capex driven companies. But then, given all of this context of social spending, rural boost, personal taxation, capital gains, capex, what's the best tactical trade around budget, Samir?
So we are not saying that the valuations of the market are high or that they have run up a lot. We are saying that the investment capex related sectors, which are primarily to do with some rail stocks, some defense stocks, a few of these general private and public Capex stocks, they have gone up a lot. The banks have not gone up a lot. The regular consumer has not gone up a lot. The rural oriented consumer has not gone up a lot. IT, which broadly we don't like much, has not gone up a lot. So there are many, many big sectors which have not gone up a lot. Only a sub part, which from a market level might be, I don't know, maybe 15% or 20% of the market, that has gone up a lot. And you can see that simply that if some Indian shipping companies have gone up more than Nvidia in the last 2 years, you broadly know they have gone up a lot. There is not too much deeper analysis required than the fact that they have gone up a lot. Even if you didn't want to check any underlying fundamentals, just from the face of it, they look odd that some stocks are up 15 and 20 times because the government might do something in the budget. So these things are too blatant to just say doesn't matter.
Sure, but then does that mean that the reasonable expectation of return from here on should be just closer to 12 to 15%, even from, let's say, the broader markets?
For now, yes, yeah, that would be a good. Actually, that is not a bad expectation, because historically, if you leave out the last 2, 3 years, that is the range. If you do slightly longer period of 5, 10, 15 years, 20 years, so therefore to revert to that for now is actually a very reasonable. I mean, not reasonable. It's a aggressive, optimistic this thing, but likely also because A, the earnings are growing, and B, there is more interest in India from the foreign investors because of market becoming big. It is now the fourth largest market in the world. It is the fifth biggest economy in the world, and also from the Indian investors. Therefore, unless it deeply disappoints, it won't correct a lot. But neither can we expect that from here on you should make 20% at the index level over the next whatever 1 year, 2 year. I think that is very unrealistic.
Okay, let's get sector specific then, Samir. And I want to begin by discussing IT sector. That's been on a tear of late. What's your sense as to, do you think there is a bit of a revival here and that is how the trade should work out?
So that was more to do with the positioning of the market. That when the market had very little of IT stocks, and a small change in even a few words here or there made it be magnified. We broadly still don't like the IT sector. We used to have only one IT stock in the past. Now we have two, but it is just done because we also could see that there is this change of sentiment which is worth a few percent points, maybe 10 12% here or there, of which 7 8 has already happened in 1 month. So I think that we still big picture don't think that IT is the leading sector. The leading sector according to us is financial sector, because it has not gone up so much in the recent past. It is mostly a large cap sector, and large caps have underperformed mid and small caps. Its valuations are mostly in line, and most probably it grows even now this year more than literally any other sector, which is 15%. Mostly these IT guys will grow maybe 10%. The consumer guys, if they grow 15, 20%, their valuations become 40 and 50 and 60 times earnings. So the financial sector grows, generally has done well in the past, so people are comfortable with the names. Their valuations are sort of low compared to their recent 2, 3 year history. And because they are large caps, they haven't done as well as the others, mid cap and small cap, where the whole thing is done very well. So all in all, number one sector for us is financial sector.
Right. Samir, private banks have clearly been, in favor as compared to PSBs, right? Do you expect a similar trend to continue?
So right now, which can we hope and are betting that the private banks will do well. Right now, what is happening is that because HDFC Bank was not doing well or is not doing well, it has put a sort of an overhang on the entire private sector, because people are not, although right now ICICI is already trading at a premium, and that is our number two holding after HDFC Bank. But broadly speaking, you don't, we can't imagine a situation that the second and the third private sector bank are treating at a premium or at a big premium to HDFC Bank. So once HDFC Bank moves, if it moves, then that'll release space for everybody to re-rate a little bit. But otherwise, In the worst of situation, I think that these banks will grow much more than IT will grow as a group or consumer will grow as a group, at least in this year, and maybe also going forward, because that has historically been their growth over time, which is say 15-20% in earnings. Last 2-3 years, the big guys haven't moved in prices, which is basically HDFC Bank, Kotak Bank, and maybe Bajaj Finance. So now we have to see, but fundamentally, history of the fact that they actually have done well all their life, it is not something new that we are discovering, and that the growth rates are much better. And companies are otherwise known, well known, and people have accepted them in the past, and they haven't done well recently. Most probably the rotation will come there someday.
Right. Samir, when it comes to oil and gas, they've clearly been one of the investor favorites of late. Be it city gas distribution companies, upstream oil explorers, or for that matter, even OMCs. What has changed here that's leading to this new investor interest? And was it just about relatively cheaper valuations?
So I think there were two factors. One was that uh, in 22 onwards, people, for whatever big picture reason, started, not people, but it just happens like that, that the value started outperforming growth. And for many years, growth had outperformed value. So value means you're buying cheaper companies, companies with assets. And that is why PSUs did well, because they were cheaper companies and had assets and were not these high flying growth companies. So that helped. Second thing that helped was that the government became a bit friendly to the oil and gas sector by not forcing price cuts even when leading up to elections. There was only one very measly 2 rupee price cut, which obviously would not have, even in the best of situation, changed anybody's political fortune, which meant that you gave the companies more freedom. And but now the issue is that last year was a very good, strong year for these companies, because at least for the oil refining companies, because they bought a lot of oil from Russia, and the discounts at that time were some $15 per barrel, which are now gone to $2-3 per barrel or something. Therefore, their margins will look, their refining margins will look much lower compared to last year. Plus, all these guys have now announced big capex projects. So now is the tough situation, that where the year on year comparisons will not look good. Plus, you're making new massive investments. And one part of the re rating for the entire PSUs and value stocks has been done. So it is now not so obvious.
Okay, Samir. So it all comes down to the fact then which sectors do you think has the potential and which is not fully priced in the kind of earnings growth other than financials? For instance, which sector do you see 15-20% earnings growth which are fairly valued and provide a good risk reward context right now?
So for that, please look at our mutual fund, because they buy sort of similar stocks. I don't manage the mutual fund, but the research is common. So no point my giving the names anyway. 100% of the portfolio is available. You can see any name, go and type and see what is the expectation of that stock price. You will find it is somewhat turning out to be in that range. There are many in consumer. There are in pharma, one or two we have in IT, in financials, and then these very high flyers, which were these stocks which have gone up 100 200% in a year, particularly the defense type. All that over time we are reducing, because we think that the budget, although good, will be a turning point, because you realize that it is good, but you know it, and how much can you bet on higher and higher numbers and beyond whatever is laid out that day or in that month.
Okay, and just before we let you go, Samir, a quick question as far as the overall Fed rate trajectory is concerned, because now the expectation has moved that it can be as soon as the month of July itself. How much that matters to the Indian markets and how one should read all that is happening in the US right now, right from the political arena to what the Fed expectations are?
It matters a little bit, because there'll be less pressure on the rupee, and that helps with foreign investors, and it helped me if the rupee doesn't depreciate. Secondly, give some room to the government RBI to one day cut rates maybe after 2-3 months. And in general, if the world is doing well and the US is doing well as a market also, then that puts less pressure on every day us looking at overnight signals and saying, oh, the world is down, how can we be up? So it sort of puts everybody a bit, makes everybody a bit more relaxed. And but I don't think it's happening in July. Maybe by September it'll happen, but who knows?
Right, Samir, so good to have you on the show and, pencil in what you're anticipating from the budget.
If you like this video, then like, share and subscribe to ET Now.